Hey guys, Mike here again. Mike Sharp, Sharp Investing. I want to talk about flow traders today, but first I want to congratulate Argentina on their big win in the World Cup. And I would also like to congratulate Emiliano Martinez for the photo of the year. Anyway, on to flow traders. First of all, I just want to thank Sven Carlin. If you're watching, probably not, but if you are, I just want to say thanks. This idea came from Sven Carlin, who's a fantastic YouTuber, as you guys probably know. My personal strategy is I'm happy to take ideas from anywhere and sift through them, but I am not a cloner. I'm not a person who's just going to buy something that I don't understand, because I've done that before, and I think the big problem with that is if something goes against you, and in my experience, almost everything goes against you in the market. Anything I buy is down at some point, and when I don't fully understand something, those points in time are very difficult to hold on through. So I only buy stuff that I feel like I have a very good handle on, and so I don't have that many holdings. I think I've got 7 or 8 right now, and I'm just going through ideas all the time. But this idea came from Sven, so thanks again, Sven. Now, the last video I did, I was a little bit confused on some of the margin stuff, and I wanted to spend some time trying to understand that. And I have spent a chunk of the last, I don't know what it is, 4 or 5 months since I did that video, trying to understand this company a lot better. And I do think I've got a better handle on it now. So I'll talk a bit about what I learned in the meantime. And for anybody who's interested in this company, they did a very good capital markets update. So I would highly recommend looking at that. I mean, it's pretty long. It's about 3 hours, but you get some really good information there. And one of the things I did get from it was that this management team is very they're not short-term oriented at all. They think big, and they're long-term thinkers. And one of the comments they made was, "We like to prepare for 100 or 1,000x." Right? So they build these systems and these platforms and their business model with the idea that it can scale up really big. So I thought that was quite positive, that little comment. And one of the other comments they made was something like, "We try to think 3 to 5 years out." So with all that, I'm going to get on to some comments about the margins. And last time when I was looking at it, I thought, oh, the margins are decreasing over time. It looks like they're compressing over time, even though the volume of trading is going up. And I was a little bit confused by why that was happening, right? We had high VIX, we have some, big events like, the war in Ukraine that have come along, and the earnings didn't quite respond the way I thought they were going to. And one of the things they talked about in the capital markets day was, they said, well, they didn't say this outright, but what I got from it is that margins are decreasing, and it's by design, right? So a couple of the reasons for that are they're basically competing. They're trying to get the costs down by tightening the spreads and become one of the low-cost providers. And so they're making less per trade all the time as they try and squeeze out some of the competition. So that's one of the reasons. I think that's good. That's going to increase their market share. That's why they are increasing in market share. That's part of the reason they're gaining market share right now. And then, so, just like a Walmart strategy, you get the price down and you get more customers. So it's a volume game. But they say on the other side of that, their main strategy for growth over time in terms of the trading income is that they expect the actual sector, the segment that they're in, to grow by 20 to 25% per year. So basically, they get the growth of the industry plus the market share growth minus the margin compression. So that's their strategy for growing over time. So they won't get the full 20 to 25% unless the market share growth offsets the margin compression. So what's the other? It was another reason too. let me see. Oh, actually, they were one of the things they talked about was that they have limited trading capital, right? So so that means they have to choose where they focus, right? In equities or in bonds or in currencies or crypto. And what they're doing right now is they're focusing on diversifying their product base. So typically, historically, they've focused mostly on equities, and that's where their big margins are. But now they're expanding into these other areas, bonds and their CCC category. And so they're taking some of the trading capital that would go to equities and they're diverting it to these other products. And they said the other products actually have lower margins. Right. So what they're doing is they have a 2-year strategy. They're saying we're going to build those out. We're going to divert our trading capital, and then in 2 years those will be up and running fully, and then they'll be a bigger, more diversified company. They were kind of saying, one of the analysts asked a question. They said, "Well, why don't you put more capital into equity if that's where the margins are?" And they said, they're not really trying to maximize margins right now. They're trying to diversify. So there's a few reasons why the margins are decreasing over time. And actually that made me a lot more comfortable understanding, that there's a plan here. They're not just getting squeezed, right? This is intentional, and the margins are coming down over time. If we look quickly at the median net trading income, this is their key sort of metric, it seems like. And the median trading income means without the sort of excess fluctuations on the upside or the downside. So if you look at these numbers, they've excluded 2020 just because they had a huge year in 2020, and that's sort of an aberration. We maybe don't expect that to happen again at that level. But they made tons of money in 2020. But what they're doing is they're tracking their median trading income, and as you can see here, it is going up over time fairly quickly. So 19% annual growth rate on the median daily net trading income. And then if you compare it to the VIX, which is the thing I was talking about, like the last video, say actually even versus the VIX, it's improving. Whereas if you looked at the previous results, it maybe looks like it's going down, but this indicates that it's going up over time at a pretty high clip. So if we look quickly at quarter three, this kind of talks to the diversification that I was just speaking about. Now they had NTI, normalized trading income, of 112 million, and that's up 30% over last quarter, and so that's quite good. And they said part of the reason for that was because bonds were so volatile this quarter that they made more on money in bonds that kind of made up for the equity trading. And so that shows that the diversifying strategy is actually working earlier than expected. And so that's a good sign, right? So they've made money on bonds more than they have in the past in this last quarter. The net profit was almost 35 million, EBITDA margins 44. So this is still a very healthy operation. They still make money on it every quarter, and there's not really a whole lot to look at in quarter three from my perspective. Let me know if you think I missed something, but I think this is just a normal quarter, just business as usual. 79.79 earnings per share this quarter. So if you annualize that, that's over 3 euros a share. So if you take at that rate, you're trading at less than a 7 times price earnings multiple on the 21 euro shares. So, good. I thought it was a good quarter. I'm happy with that. Pretty boring. And that being said, I should have said this before, but I was reading something. I forget what book it was, but Buffett was talking about how it was a quote from Buffett, and he was saying, "I'd rather have a lumpy 15% return than a smooth 10% return." So if you look at Flow Trader's history of results, it's very much a lumpy 15%. And I think that turns a lot of people off. This is why the analysts have trouble sort of modeling it and valuing it. And this is why I think it turns a lot of investors off, because you really don't know what's coming every quarter, right? But if you look at the overall trading volumes over time, you can see that they are trending up. And so I think this is maybe a hidden gem from that perspective. Now, what else? Targets. Okay, so they talked about their longer term targets here. I guess this is a medium term target. So they're shooting at 1 billion net trading income. And again, that's median net trading income. They actually made $1 billion in 2020, but that was on that huge 2020 COVID spike. But they want to make that on a sort of normalized basis. And I think if they do that, I can see based on the sort of leverage they have on their the operating side, that the earnings should be probably, if they get there, it'll be probably between 300 and 400 million. And what that would do is, like, let's say they made 300 to 400 million in 5 years. On the low end, I could see that the market cap would be, like, let's say 10 times that, which puts us at 3 billion in market cap. On the upside, if we had a 400 million earnings year on a normalized basis, in only 4 years, you'd have had a high price earnings multiple of, let's say, 20. The market cap might be as high as 8 billion at that point, right? So given the current market cap of less than $1 billion, 950 billion at 950 million, let's say, the annual compounding rate would be somewhere between 26 and 70% per year if an outcome happened within that range. And so that's what I'm kind of looking at here. Again, it's a big, wide berth, but I like to keep my investing thesis somewhat general, so I can, there should be it should be a robust system where I can, I don't have to be precise about anything to be right. And sort of that's what I think is going on here. If they got up to that range of earnings, you'd probably see dividends of 150 to 200 million. And based on the current market cap, that's a dividend yield of 15 to 20%. And so again, that's really nice. The company is, seems to be committed to dividends, even though actually I think it doesn't make a lot of sense. If you're saying we have to choose between putting money into equities or into bonds to grow them, but we're still going to pay a dividend, well, why wouldn't you just keep that capital and do more trading? I actually don't understand what the value of the dividend is at this point, since they're in the growth part of the curve. So that might be one thing that I don't agree with here, even though I don't mind getting a decent dividend for this. It doesn't make a lot of sense from a capital allocation perspective. What else? In the capital allocation perspective, they've upped their buybacks. I think it's at 25 million now. So that would be 2.5% of shares. But you also have to take into account that a lot of those are going to employees as stock options and grants and things like that. So it's not a full clean buyback. Let's say maybe you get 1.5% in buybacks. What else do I want to talk about? Return on investment, return on equity. This company, I like to use the return on equity metric as opposed to return on invested capital, just because the balance sheet is a little bit of a mess. There's a lot of, whatever day they take the balance sheet data from, there's a huge amount of assets and liabilities that are just tied to their actual trading that don't really have anything to do with the company in terms of capital that they've employed. So if we use return on equity, let's see where we are. Oops, what happened to my list? Hold on here. Okay, return on equity. So if I look at 2020, the return on equity was almost 79%. 2021 was just under 23%. And this year, through 9 months, if I annualize it, it's over 30%. That puts the average at 44%. So there's a huge, the return on equity here is quite huge. And the reason for that is this company has sort of scalable platforms and tech stacks where they don't actually, in order to grow, they don't need to actually invest very much in any new assets, right? They just sort of they can hire some new people to manage the bigger workload, but in terms of assets, there's not really a lot left that they need to invest. So that's really positive for me as an investor, because it leaves most of the earnings that they've generated in the management's hands to do things like grow and issue dividends and buybacks. And also what they've done is they've started this VC fund, and it actually looks like that's going as well too. So most of the cash generated is actually able to be deployed to increase the return for the longer term. Now on to what's the next topic here? Growth and the catalysts. Okay, cool. So growth, obviously I talked about bonds and their CCC portfolio, and those are the main growth engines, but they're actually growing they're growing globally as well. The US operation is growing quite quickly, and in Shanghai, they've just opened that up. I think they've just opened it right now, and that should add, another avenue to growth. And again, they said they basically didn't need to invest hardly anything to get that office up and running. They just needed to get the permits and the staff in place. What else? So, so those two things, they're saying it's a 2-year investment window. So that puts us, we're almost a year into it. So I would say in 2024, we should start seeing the real fruits of this investment in these new growth engines. And then the last maybe wild card here is that the VC portfolio could actually do quite well. Now I'm not counting on this. This is a bonus. This is, if it goes well, but usually with VC, like you invest in a bunch of stuff, and for them, actually, they're trying to get some synergies with their current platform. So they're getting benefits that way. But there's also the upside potential that you might get one that goes through the roof, and then you have this sort of lottery ticket situation where one small investment could double, triple, 10x the whole company value. Now I'm not betting on that, but there's that possibility out there when you're doing these kind of investments. Last topic here is the risk. Now, the more I understand about their risk mitigation strategy, the more comfortable I feel. Like they have not taken a loss in one single day since 2017. Now think about that. They have not had one losing day in over 5 years. Okay, and that includes a huge mess in 2020. That includes the Ukraine war. That includes all different types of market environments, and they have not taken a loss. And so these guys are hyper focused on risk. So they're either immediately offloading the position, or they're immediately hedging the positions that they obtain through the market making. They're immediately hedging them with as perfect a hedge as they can find, and so that happens immediately. They don't carry hardly any risk actually on the books, so that's good. Now, I do still think counterparty risk is a possibility here. So if they're not able to offload their risk immediately, it could open up to risk if one of their counterparties blows up in the midst of one of these transactions. That could create counterparty risk. Another risk is that if you're holding this and we get a bull market, one of the risks is that it could underperform the whole market. So you could actually just drag your whole portfolio returns down, because this company typically doesn't do as well in low volatility environments, and low volatility is usually bull markets. Steady bull markets are the lowest volatility markets you can find. So that's that's a portfolio risk, I guess. But it's offset with the idea that in bear markets they actually make more money. So you have it's a bit of a hedge. It's a bit of a counter trend position. Now, I mentioned this before. The main risk for me is that their projection about the market doesn't materialize. It doesn't go up 20 to 25% per year for the next 5 years. And let's say it goes up 5%, and this ETP market where they're really focused. Now they are in individual bonds now as well, and they're getting into individual securities as well. But let's use ETP projection for now. That's their bread and butter. If that doesn't grow as they expect, because let's say a bear market scares a bunch of investors away, people pull their money out of the market, they don't want to invest anymore. Typical what happens after a bear market. You could see this low growth rate, and then if they are trying to hammer the competition with lower prices, you could end up with a no growth situation, or maybe even worse. So that's, for me, that's the biggest concern. And then the last one is the people risk. So they say that people are their moat, and so that opens you up to the risk that they get poached by competition, and that some of their trade secrets go to the competition, and that stuff happens all the time. I'm sure they're poaching from other organizations, and I think that's normal. But if you had a major exodus out of the company, then they may suffer. I think that's it for now. Overall, I really feel comfortable with this company. I don't worry about the position at all. I always know how much I like my position by how well I sleep. With ASOS, I'm not sleeping that well, so that gives me a hint on that one. But this one I do. I sleep really well. I don't really care what the stock does. I'm just going to leave this. I'm going to let them do their thing. I'm going to let them get to 1 billion net trading income, and give them some room to do that. And then hopefully when we get there, they'll say it's 5 billion, their goal. And they're going for that 100x. But for now, I'm happy with this position. Oh, and I forgot to do the disclaimer. So the disclaimer is, don't invest in YouTube videos. That's nuts. Don't be crazy. Do a lot of research before you buy anything, for anybody who's new out there. And I'm just a guy. These are just my opinions. If it helps you with your own research, great. But I'm not claiming to be some kind of guru or anything. But yeah, that's it. Have a great day, guys. See you in the next video.